The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Welcome to How to Money with Kole and Kole.
I'm Kole.
And I'm Kole.
We coach people every day on their money and how to plan for the future.
As financial advisors, we're here to have an honest conversation on investing, retirement, and everything in between.
At Full Swing Financial Planning, we're here to empower you to take control of your plan, your way, for your financial future.
So let's talk money.
And sports.
Welcome back to How to Money with Kole and Kole. Solo Kole here again today. One Kole with me.
We should just rename it How to Money with Kole.
Yeah, which
because
Kole?
Only one of us is usually here.
How to Money with Kole and Baileigh.
Oh, there
then
you
it
go.
works because you both have the same name. It's a little twist on it, but yeah, it's always nice. You got baseball full effect. Summer's coming to an end. We got a lot of stuff going on.
I'm ready for summer to come to an end. I'm sick of going to bed at 10:30, 11 o'clock at night. But I also love summer, obviously, because the weather's nice. But it's
a love-hate.
Yeah, when school starts and it becomes fall, that is my favorite time of year.
Same, more routine.
And there will be some baseball playoffs, hopefully. Cubs currently first place in the wild card, second place in the divisions.
What is wild card? I don't even know what that means.
So in every in the American League and National League, so let's just talk about the National League, there are three divisions. Mm-hmm. So there'll be one division winner for each division, and then there'll be three wild cards. They can come from any division. That means the three next best records make the playoffs.
Gotcha.
So the Cubs are behind the Brewers in the division right now. As of this is Tuesday, July 29th, that we're talking. They lost last night to the Brewers. They're one game behind, but they are first place in the wild card. So they're
looking good.
They'd be the 4 seed and would get some home games. So that would be good.
The question is how far they go, how far you'll go to the games.
Well, here's the thing is, if they actually make the World Series, which I'm not saying they will or predicting.
Knock on wood, they might.
I will not be going. There is a family trip planned, not thinking the Cubs were going to be this good. So I will not be going.
Is there a chance you would call an audible?
No. I know I can't do that. I mean, the entire Peterson family is going. So, yeah, that's my dad, my mom, my brother.
But how many times are they going to make it to the playoffs in your life?
I don't know the answer to that.
Let's not get into this. Family might listen to this and they're not going to like how I'm pushing you. But yeah, it'll be good. I'm ready for school to start. We like fall. We do events. It just gets a little more routine around here. Summer's a little hectic with children.
I was just looking at football practices and kind of getting when those are going to be scheduled. So that's kind of fun. I coach football and basketball for my kids, and so I'm looking forward to that. I take baseball off, and finally that's over. So that's coming up here.
A little tidbit: Cole P used to coach my son's team, Damek, with Luke and the other Cole on the pod, but Cole P's retiring on him, and they were like, "Dang, who's going to write the play?"
Yep, my girls have decided they are not going to play football this fall. My twin girls, one is going to play volleyball and one is going to do soccer. So they are not doing football for the first time since preschool or kindergarten. I don't remember. So yeah. Kind of sad, but kind of not. Like I know
you won't have to coach as many teams.
Yeah, I knew they weren't going to play football all the way through. I assumed they wouldn't.
Hey, that's an up-and-coming thing, though. I'm telling you, girls doing different sports like wrestling. You think about wrestling, so
we'll talk about girls. WNBA's in full swing. So they're through the All-Star break. So how many more games do they have left?
They'll be starting the playoffs September. We'll see if Clark can. She's
been hurt.
I know.
Poor thing.
Growing and missed the All-Star. All-Star game was fun. I was watching with a couple friends. They're like, they're not playing serious. I was like, what All-Star?
Have you ever watched an All-Star
game? I literally said that to him. I said, have you ever watched the NBA one? I said, no one tries until the last 2 minutes of the game. I said, they were all out partying.
The only one that matters is the MLB All-Star game because the winner gets the World Series. But they don't want to make the other ones competitive because they don't want to get hurt.
Yeah, you're not going to risk your season.
Yeah, you're not going to get hurt.
It's for
baseball,
fun.
really.
It's just for celebration, Yeah,
did you see the end of the MLB All-Star game?
No.
So they don't go to extra innings because they don't have any more pitchers left.
So what do?
They do a swing off.
Oh, that's kind of cool.
Yeah, so they do like a home run derby basically for who wins it, and the National League one, Schwarber hit. So they pick, I think it was 3 guys, and they all get 3 swings, and Schwarber hit all 3 home runs.
Oh, damn.
Kyle Schwarber, who used to be a Cub, now plays for the Phillies, but it's kind of cool.
I just feel like people who like, oh, he used to play here, now he plays here. That's just like a true sports fan.
That's just the way of it right now.
Yeah. Well, let's get into it because you read 900 pages for our listeners, Kole.
I did not.
The one big, beautiful bill. I saw you downstairs reading it yesterday just for this podcast.
Yep. All 900 pages in one day, and I understood every word.
Yeah. But federal policy has been passed. There are changes financially. We think it's important to go over them. Obviously, we'll start with this and end with this. No matter who's president, what changes are taking place, we truly believe financial wins are done at home, consistency and working on your plan. But we still want to go through these. Yeah,
this is more information for our listeners. This is not recommendations. This is not like trying to change your retirement plan or anything like that, but things that you should know, things that may or may not affect you, but something that we feel like, it's obviously people are talking about it. We got to go over the things that people are talking about. And this is definitely one of those.
Yeah. So number 1, tax cuts extended.
The 2017 Tax Cuts and Jobs Act, TCJA, that was passed in 2017 when Trump was in his first term. They were set to expire in 2025. They've extended those indefinitely. Basically that helps people because the tax brackets are going to stay the same. They're not going to go back to the old tax brackets. So now everything continues as is with normal inflation on tax brackets.
Yeah, and it just gives long-term planning stability for individuals and business owners. If you're trying to do a Roth conversion, or if you're going to make a little more money, it's just where you're going to set. So
it's really convenient for us retirement planners because yes. our software that we used reverted back to the old tax brackets in 2026, and everyone's taxes went way up. So now that has brought that down, and they've made the adjustment in our software, which is great. And then, I think it's just long-term, it's easier to plan if you know what tax brackets are going to do.
Yeah, and they were set to expire, so they are now extended until further notice. So,
indefinitely, yeah.
Yep. Another change, the standard deduction increased $15,750 for single filers, $31,500 for joint, which also helps simplify taxes and reduce taxable income. So it's gone up.
It's going up.
Yeah,
so for people that don't understand what a standard deduction is, so Baileigh and Luke are married.
Lucky dog.
If they don't itemize their write-offs, if they don't itemize their mortgage insurance and their business expenses and all these different expenses, they get a standard deduction on their taxes. So say the two of them, and I'm just going to use simple numbers because this is not the actual numbers, but say the two of them together make $100,000. They are married filing jointly. They subtract $31,500 from $100,000. They now file taxes and pay taxes on $69,500 instead of on the $100,000 that they grossed.
Perfect example. I love that. But it's good to know.
Yeah. It's not something that is going to affect a lot of people's overall outlook on everything, but it probably is going to save people a couple bucks on taxes.
Yep. All right, the SALT deduction cap raise, which we were talking about this off record, it goes back in 2030. We're not sure why, so we're not going to stay on it, but it goes from $10,000 to $40,000 and then phases back to $10,000 in 2030.
So to simplify this, instead of using SALT, it's basically state taxes.
Yes.
So let's just take Iowa because most of our listeners are Iowa and we're in Iowa. So right now, I am only able to write off $10,000 on my Iowa state taxes. That amount is going to $40,000. Most people don't have $40,000 worth of write-offs, but it's going from the max being $10,000 to $40,000, which will help some people and some businesses that write off taxes. It does. This is one of the problems with the bill, quote unquote problems. This is people don't like this because it's mainly a win for high income people. But the reverting back to 10,000 in 2030, I do not understand why it would go back. I think that's probably something that they made a concession at the last moment. Again, we don't talk politics, but I'm assuming that the Democrats or the people that didn't want the bill to go through said, well, we can't continue this forever. Let's have a deadline on it. We're going to go back like the Tax Cuts and Jobs Act was supposed to go back. So They made it so it reverts back to, it's temporary.
2025 to 2029. And then it does help, again, if you itemize your deductions.
Right.
That's basically who it's helping.
If you don't itemize your deductions, this one does not apply to you. So if you work at a job where you just get a W-2 and your wife does, or vice versa, or whatever, this does not affect you.
Yep. All right, next one. There's a lot here, so we're gonna riff through them. So, senior bonus deduction. You're not there yet, Kole. You're a little ways away from the senior deduction. I'm sorry.
Closer than you are, that's for sure. But this is age 65.
Yeah, this is great.
So people that are age 65 and above, they get an additional $6,000 deduction on their federal taxes.
Yeah, and $12,000 if you're married.
Yep. So if you're married, now you also get the standard deduction of the third. So let's take two people that are still working at 65 and they make 100,000. So now they get 31,500 deduction plus 6,000 or plus 12,000. Excuse me. So now they have 43,500 deductions. They're only going to pay taxes on 57,500. That's
helpful.
An example of it. Again, it's lowering taxes for most people. This one is just the over 65 people. What they're trying to create is the people that only collect Social Security or only collect very minimum amount out of their IRAs, and they're not making a lot of money that they don't have to pay taxes, basically.
Yep. And don't think if you're listening to this, I got to remember all these numbers. This is why you have a financial advisor. This is why you work with your CPA. But these are things to be aware of, correct?
Yep.
That things are changing. So
yeah, and if what most of this would be like if some of these apply to you and you were saving money that you were going to pay into taxes next year at tax time, maybe you can invest that money now. Again, you need to consult with your financial advisor or your CPA or your tax accountant, whoever. But it is something to be aware of.
Yep. Child tax credit increased.
Yeah, this one's a big one for me because I got 4 of them buggers.
He said buggers. $2,000 to $2,200 per child and now indexed for inflation. So yeah.
Yeah, it's a real small change.
Yeah.
So
don't hang your hat on that one.
Yeah. So for an example, for me, instead of getting 8,000 credit on my taxes, I get 8,800. Great. It might save me $4 on taxes.
Yeah.
It's not
not moving the needle, people.
It's not moving the needle, but it's something to be aware of.
Yeah. Another one, this is quite high. Estate, which most people, this doesn't, but again, if it does, estate tax exemption rises from 15 million individual to 30 million a couple by 2026.
So this is one of the bigger ones, I think, because this was also supposed to sunset with the Tax Jobs Cut Act in 2025. So again, Trump in his first term raised the limit. It was supposed to sunset in 2025. Now they've made it permanent and they've also raised it. So what this means is if you are Grandma Jones, whatever, and you have all this farmland and your estate is worth $30 million, let's just say $20 million. For those people that inherit it, because you're a single person and it's over 15 million, they are going to have to pay estate tax. Mm-hmm. If it's 12 million, they don't have to pay estate tax because it's under the 15 threshold.
Yeah. So the government takes less of your estate if you're there.
That's what it comes down to is those people that are passing on wealth to the next generation. If they're below these limits, then they don't have to worry about the estate tax.
Yep. So, all right, another shift. Some green energy credits eliminated. Incentive programs, how they track the effects of energy, homes and cars upgrades. Some people are getting incentivized. That's kind of going away. Again, not a big change. For I shouldn't say not a big change. None of these, I'm not taking any of these lightly, but it's just most people aren't going to notice.
Yeah, I haven't heard much push for, and maybe you can comment more on this, and I haven't done a lot of research, the electrical car push that I believe Obama passed something like so many percent of the new cars that come out of the U.S. had to be, I think that's gone away.
Yeah, I think that's why they broke up. Just kidding.
Elon and Donald.
I'm not getting into politics, but yeah, there's more to it, and yeah, there's
got to be a meme out there where he's in front of like at the concert, the Coldplay concert thing. There's got to be a Trump and
First
Elon
of all,
one.
that's a money conversation, but yes, talk about viral money shifts right there. But yeah, so yeah,
so some of those are going away. I don't think, again, that affects people all that much unless you were buying an electrical car in the next 6 months, and now you're not going to get the tax credit.
Yep, correct. This one, it was talked about a lot, like what were going to be the regulations, who could benefit from it. So I think this one's good to go into is the tip income deduction. Basically, service workers, people who earn tips, they wanted to take taxes away from that. But what they did is you have a deduction now.
I like this one a lot because those people work their butts off.
Yes.
You've been in this industry.
Yeah.
I've been in this industry. It did stink paying taxes on the tips that you would get.
Yeah.
Because a lot of times those were in cash, right?
Yes.
And if you did the right thing and you reported that, you paid tax on it.
Yes.
Where now you can deduct up to $25,000 in tip income from through 2028. Again, I'm not sure why it didn't go further than that, but that we're just reporting it.
You have to be earning less than $150,000 though. This is not for everyone.
That's the big thing is those those waiters and waitresses in the really high end places in Chicago and in New York and things like that probably make over $150,000. They're not going to be able to do this, but the people in Iowa
who are grinding a restaurant job to pay some bills.
and majority of their income comes from tips, right? Yep. I mean, if you're
you're not getting a high set. That's what people don't understand. When you're in the restaurant industry or whatever, you're getting a very low hourly rate. Your money is the tips. Yep. So now you can deduct that. So if you did pay in taxes, you were a tip employee or what, I don't know what you call it, like person that made most of your money on tips. Yeah. This is something that's really going to help you, and you can maybe invest more of that money instead of giving it to the government. I did think this was important, so I wrote down a few key tips for claiming the deduction, right? Because this responsibility still lies on you, right? You got to track it. You got to be the one that has this aligned for your taxes to be able to deduct it. So you should maintain an accurate record of tip income separately from your base pay. Use an app, a spreadsheet, payroll reports, whatever, but you need to be logging how much you're getting in cash to be able to deduct that.
Mm-hmm. And this applies to overtime as well.
Yes.
So it's tips and overtime. So if you work in a job where you're working overtime and not getting tips, I believe you can deduct the $25,000 worth of overtime. I'm not sure if people, like, say you work at, and this is a question that I don't know the answer to, say you work at a factory here in Fort Dodge and you work $25,000. Are they going to not tax it on your paycheck?
No.
Is that something that you have to do at tax time?
Okay. Tax time.
So they're going to have a separate item in a W-2 that says how much you make. Although they do already. Yep. They do have an overtime slot.
Yep. Yeah. So it'll be there. It's just, you got to make sure they're tracking it correctly. It's something to just be aware of. If you're working overtime, just track it. Make sure it's being tracked accordingly with your employer too. So that is awesome though for the people that work overtime. You know, you're going to be able to, hey, that first $25,000 that I make in overtime, I don't pay tax on. I just think there was a little confusion. Because I even think about Luke, his industry is a plumber. A lot of the guys make overtime. Like, I think they thought, oh, I'm just not going to pay tax on it. It's a deduction, right? You gotta track it. It's not like it's coming right off the paycheck tax free. So
correct. Yeah, it is a deduction, and I don't believe this is at the state level either. So if you pay state income taxes like you do here in Iowa, this is totally on the federal level.
Yes, good to know. So yeah. All right, this one, just before I get into it, I'm just going to be honest. We're not sure on the logistics.
Oh boy.
We're not sure how this is. And I did research, and I even was looking at other financial advisors' opinion. No one really knows the logistics on this. So please, not that we don't want you to, but right now we can't, I don't want to say help you, but we're not sure even how this is going to work yet. It sounds like it's still a gray area, but new Trump accounts for newborns, which is a very interesting concept. And we'll get into it. But just so you know, like if you come to Kole and Baileigh, like, hey, open me a Trump account, I'm going to say, I gotta figure this out first. So,
well, from what I understand, we can't open them. They're open right now. Yes. Right now, they're opened by the federal government, is from what I understand. But again, sometimes they pass these bills and they don't have all the logistics worked out. They did this when they passed a bill on the were required minimum distributions, weren't required by
Secure Act.
The Secure Act. So anyway. So what's going to happen? If you have a baby after January 1st, 2025, so sometime this year or anywhere through 2028.
Kole and Baileigh decide to have one more next year.
No.
Okay, go on.
But Baileigh and Luke do. Say they have a baby next year. The government is going to put $1,000 in a Trump account. Not sure again where it's located. I think it's with the government. I don't know if it's.
We'll come back to you on that.
Could be Vanguard, Philadelphia, whatever company they choose. And then after that, parents and grandparents can contribute up to $5,000. Parents, relatives, and others contribute to $5,000 a year for this, tax deferred. So you can use it for basically anything that you want to use it for. There are no qualifications.
It's like a hybrid.
Yeah.
It's like a Roth IRA, 529, HSA. It's basically, I think it's the idea is to teach people to invest. Like, look what this will be worth when the kid's at 18, 25, low index funds. So they're low cost. So yeah.
Unlike a Roth IRA or 529, though, you don't have to justify why you're taking the money out. You don't have to show a receipt to your tax person that says, hey, I took this $10,000 out of this 529 for tuition. Here's the bill that goes along with it. This account, from what I understand, is going to be completely flexible to what you want to use it for. So you can get the $1,000 put in, and I think you can close it right away.
Yeah.
If you wanted to, but that's not what it's meant for.
This is what I did find out. Basically, it automatically triggers. Kids born, the government deposits $1,000 to the Trump account shortly after birth. There's no income limit. And then, like you said, ongoing contributions from parents. Even as the child gets older, employers can contribute up to $2,500 per year. But it's just interesting. So we're going to do this, and it technically sunsets again back. It's like, is it like a test air of these kids of what it's going to happen, or are they going to see how it goes and then extend it again? It'll be interesting.
Yeah, I wonder if this one will continue or if this is going to be short-lived. I don't know. I do like that the employers can put $2,500 per year, because that's something that employers can start offering as part of their benefits package, that they'll put so much in these Trump accounts for their kids. But at the same time, I see this being very short-lived. I don't see this being a long-term thing, but what do I know?
We'll see. And at age 30 or 31, funds not used may be distributed. So it'll be, I feel like it's like 529s. When you first did 529s, they were very limited, and now they keep extending and all the rules. I feel like it's going to be something like that, where it keeps changing and evolving if it stays. So
I would agree with that. It says that it's treated like a traditional IRA. Mm-hmm. So there's a 10% penalty if used before age 59 unless qualifying uses. Okay, so there are qualifying.
Yes.
So I've read on this, and now I'm reading these notes, and now I'm like, oh my gosh, at age 30 or 31, funds not used may be distributed for...
Tip of this one, if you have a kid in this era, make sure you're tracking and you get your account and you know where to locate it, because you should take advantage of it. I mean, it is a great thing for your kid personally if this happens for you. So it's good to know.
Yeah, and this is supposed to happen automatically, right? As soon as they have a child and
the government
and it has a social security number, the government is supposed to put this into an account. So you're going to have to locate it. It's invested into an index fund, so it doesn't look like you're going to have to pick what it's invested in.
Maybe
but there are
give
rules.
Our listeners, what is an index fund, Kole P?
Yeah, so a U.S. stock index fund is what it. So example, S&P 500. So the S&P 500 index fund, or most famous one probably through Vanguard, invests in the 500 biggest company, just like the S&P 500, and it tracks basically how the quote unquote stock market is doing. But I did not read far enough into this to know that basically there is going to be a penalty if you take it out without a qualifying use. Okay. Well,
but there's more qualified uses. I feel like trade school, like that's what I'm saying. It's like a 529. The qualified expenses are.
I bet there's something in there for medical expenses if you have it. Yeah. So you can close it, but you're gonna have to pay a penalty if you don't have one of these reasons.
So keep you posted on that as it's ever growing and changing.
This podcast is produced by Spin Market and Digital. Located in Fort Dodge, Iowa, Spin Market's highly skilled team can help you increase your market by updating your website, improving SEO, designing advertisements, and producing podcasts that will grab the attention of your market. Contact Spin Market today for all your digital marketing needs at digitalagent@spinmarket.com or call us at 515-302-8026. And to learn more, visit our website at www.spinmarket.com. That's digitalagent@spinmarket.com or 515-302-8026. Or visit our website at www.spinmarket.com.
Let's do a little dollars and cents.
Dollar bills, y'all.
got to queue yourself up there on the dollar bills, y'all, because Kole's gone.
Yeah, our stat nerd is gone, so I'm going to try to take over his spot here, but I can't nerd out as much as him. But so we're going to talk about stock returns, stock market returns so far this year, and what's happened so far this year. So beginning of the year was okay. Market was kind of humming right along, and then tariff time happened.
What was that?
In March and April, as everyone can remember, the stock market had a significant decline, was down about, and I'm talking about S&P 500. So S&P 500 started the year just a shade under 6,000, and it went down to a shade under 5,000. So it went down 1,000 points, which is roughly of let's just say 15% down. So roughly 15% down in April from the beginning of the year. This is why you stay in the market, because currently year to date we're up 8.75%. So a 23% change since April in 3 months, mainly because the whole tariff thing is starting to get worked out. Yeah. The trade war is, although it's still ongoing, there's a lot of information coming out about how Japan came to an agreement, UK came to an agreement. I don't think it's going to be as big a deal as everyone thought it might be back in March and April. So consistency, we've talked about it,
yes.
And not panic. There are always going to be things that happen with and change markets.
Control the controllables.
Yeah. You can't control it, right? You can control how much you invest, how much risk you're taking, how
consistent you are with your contributions.
Yep. So if you just invested at the beginning of the year $1 and watched it go down to 85 cents, now it would be at $1.08. So that's why you've got to just stay the
course, stay the roller coaster. And we get this a lot too. I think about that time frame when this was happening. We had a couple people I'm going to lose all my money. It's all going to be gone. Or this is why I don't invest. Or I'd rather just put it here and cash out now because I don't know what's going to happen in the world. We talk about this. I'm like, I understand the fear. I do. But it's also historically, if you just look at the market historically, it's going to, you just got to stay in the ride, right? You got to ride the waves. And that's just part of investing. And that's why the people who invest long-term stay in the market.
And invest consistently, because that money that you put in April when the market was way down has now made 23% in less than 3 months.
Two type of clients. One, when the market's down, phone's blowing up. Pull cash in, buy. Other ones, oh my gosh, am I going to lose all my money? What should I do? Would you agree?
Yeah, the people that understand the market know that was a buying opportunity. Yeah. So it was a buying opportunity. Market was down. Should be trying to, if you have available cash or you have a CD maturing or something like that, and you can take on the risk, that was the time to get into the market, not the time to get out.
Yeah, and we don't even, because timing's so hard. But I get it if it's available. But again, it's just consistency. There's always going to be legislation noise. There always has been. There always will be. It's not going anywhere. So.
Yep. So consistency again across investing makes people invest when they are not quite certain what's going on, but if you invest long-term over time, last 5 years, the S&P 500 is up 95%.
I'll take that.
Yeah. So if you put in $1 back 5 years ago, it's now worth $1.95. Most people would be okay with doubling their money every 5 years. And
I think it's kind of like a muscle, right? You got to practice using that muscle when it's feeling weak, when it's feeling strong. If you just keep using it, it's going to work out for you. But if you just say, hey, I'm going to take a break, this is scary, you're missing out on the opportunity for growth.
Yeah, don't take a break when the market is going down. The time to take a break, if you need to take a break, is when the market is high.
Yeah.
And the time to sell is when, sell market went high, buy
low.
Buy low, sell high. If you go the other route, you're going to end up shooting yourself in the foot.
If you need emotional counseling, we do a lot of that.
We do. Yeah.
Okay, let's get into a few more of the changes. There's a lot of changes. They're evolving. We're going to keep talking about them. We're not going to get through 900 pages today. If we feel something's important or we find information, we're going to talk about it in future episodes, so make sure you listen to those. But we just want to get through some that we really stuck out or thought, people are talking about.
Yeah, I did the 900 pages yesterday. I don't want to do it again today.
Could you imagine my ADHD trying to read 900 pages? Woo!
Woofty.
Woofty. Okay, student loan changes, which this is interesting because Obviously, I feel like before we get into it, student loans are a black cloud over a lot of people. We were talking to our producer before this, Peter. He's like, when I was getting student loans, they were offering me more than I needed. I didn't even need that much. They were like just saying, hey, what if you can't work? Or, my husband beer money. So it's a good thing. They're kind of, I don't know if this is the solution, but it's going to put some pressure on colleges, I think, too, with pricing. But basically, they're capping a lot of the loans per degree. So graduate plus loans for master's, law, med eliminated for new borrows starting in July 1, 2026. So you can only borrow on unsubsidized direct loans with limits. Annual and lifetime borrowing limits for grad and professionals capped at $50,000 a year and $200,000 a lifetime. So Cole Peterson can't walk away with over $200,000, which that even seems like a lot, $200,000, but
that is still a lot. But people do walk away with much more than that.
Yes, for law and med. And then $20,500 a year and $100,000 lifetime for other graduate degrees. So depending on the degree, also parent plus loans limited. What that is means a parent signed off on that loan. Like if you couldn't pay it, they'll take the responsibility for it, which I think this is good too, because you do hear a lot of parents, I think they just sign them not knowing the consequence that they're just as much responsible as their kid. If their kid goes to school, messes around, doesn't, so that's $20,000 a year, $65,000 a lifetime. So your overall lifetime cap, excluding Parent Plus, is $257,500 starting July 1, 2026. And you said it too, like, so what if you're going to a 4-year degree and it's more, what are you going to do?
I think people are either going to have to get a job and pay for some of their school while they're going, if they want to go 4 consecutive years.
Cash flow.
Or you may see people go 2 years, get a job for 2 years, and then go back for 2 years. I don't know the answer to it. I don't necessarily agree nor disagree with this. I think it's a good thing to put a cap on it. I don't know if the numbers line up, because there are definitely schools that are more than $50,000 a year, especially with room and board. But at the same time, they had to do something.
Yes.
Because people are just, if you are borrowing to go to college, you do not need to borrow more than $50,000 a year. It's kind of ridiculous.
Well, and I think it takes away from the idea of, I want to go to this school versus do you really need to go to that school? Out of state, prestigious, like they all cost different. I mean, how many doctors do you walk into their office and you say, hey, by the way, where'd you get your degree? I need to know before you give me medical. None. I never asked a lawyer or anyone what school you went to. So it kind of takes that young mind system out too, but it'll be interesting. And then new borrowers starting July 1st, 2026 too, will only have 2 repayment options. A revised standard payment plan, 10 to 25 years, depending on this loan size. So the smaller repayment size, you can't just keep paying, deferring, and a new income-driven plan called Repayment Assistance Plan. It's RAP. So older plans like Save, ICR are all eliminated. So by July 1st, 2028, existing borrowers who are on those plans, Save, ICR, must choose or will be auto-enrolled in the new payment plan. So that'll be interesting too. It might a little pressure on people who, maybe been kicking down the can or can't afford that time. So there'll be some pressure and changes. I don't really know the answers, but there'll be changes somewhere along the line for people.
I do think this will eliminate the people that go to college for a general studies degree. Not that there's anything wrong with that don't know what they want to do, don't know what income they're going to make, because they won't allow you to just pile up $200,000 worth of debt. Well, they will allow you to borrow up to $200,000, but you can't pile up $300,000, $400,000 debt just because you want to go to Michigan,
right?
And you live in Iowa and you're going out of state or wherever. I mean, name your school. I just named one that is kind of prestigious in the Midwest. But just because you want to go to Harvard, you've got to be able to afford it, or have parents that can help you out, or have a job, save up for it. I mean, that's why I think it's going to maybe also, force children in high school to save for college, which they should be doing anyway.
Or apply for more scholarships, like find other resources than just straight going to, I'm going to borrow the money, which is the default of the United States. It is. It's just, I'm going to go to school, really I'm going to get loans. So these 2 payment plans, the RAP, payments are 1 to 10% of your adjusted gross income. It's a fixed minimum $10 a month payment with a 30-year forgiveness timeline. So basically, you got to pay the minimum 30 years, it sounds like. It's forgived. Include spousal income only. So it'll be off you and your spouse's income. And then the standard plan, it's a sliding term for 10 years. There's amounts, basically it's a sliding payment for 25 years. Longer terms don't qualify. So different 2-payment options. If you are going down this route, starting 2026, if you're a younger listener or if you have kids, study these 2 plans and figure out which one's best for you. You got to figure this out because your old pay save plans, they're going away.
Yeah, my oldest child is 15. This obviously is only 3 years away from me. Something that I definitely am going to keep an eye on because it doesn't look like this one has a sunset type of deadline. This looks like this may be how we are going to go about student loans for the foreseeable future. Yeah. So this is something that, myself, Baileigh with her kids, like we've got to pay attention to this because we also got to make sure that our kids are, not that we weren't going to make sure they're responsible about taking out loans, but now we've got to even be more cognizant of this.
Yeah, and I think, again, it's just a good talking point for children. Like, hey, you can't take this much. I wouldn't want you to take that much anyways. Here's why. And we talked about this a little before. 529s, there's a few changes, small changes with this too, is, everyone's always like, oh, I don't want to put money in a 529. Well, which they made the change in the Secure Act that now you can roll that to a Roth IRA. But they made changes in this bill now too. They upgraded the limit to $50,000, and also you can move it if your kids aren't used. Let's say I start saving for day 529. He never used it. I can roll it into a Roth IRA in my name. So there's
for yourself. Yeah.
So they're evolving these plans. So they're encouraging you to save for college and not limiting what that 529 can do. So if your kid, because that's always the fear, I don't want to save, or they don't go, or they get a scholarship. I'm just going to say this: most kids don't get scholarships. So
not full rides.
No, don't bank on that. But it's just good to know that these changes are evolving, and somebody's got to do something about student loan debt because it is a game changer.
The 529 change to be able to roll it into your own Roth IRA. Now you're going to be still subject to the $8,000 or $7,000 limit if you're under 50 or over 50.
Yes.
But that is a big change because before you could only roll it into a Roth IRA for your kid, which was nice positive and everything. As well. Yeah, which was positive, but also
it's your money.
I mean, if your kids get through college and they don't use their 529s, most likely they're a pretty successful child, or like,
yes.
they don't need the money into a Roth IRA. You can teach them how to save into it. You can roll it into your own and then maybe retire a little bit earlier.
Yeah. It's a good backup plan for yourself. Like, hey, I'm putting this money here if I need it for school, or hey, if my kid's not doing what you don't have, they don't, you know what I mean? You're the owner, like they're the custodian. You can change it. So a lot of changes. That was a lot at once, Cold Pete.
Oh my gosh. There's a lot going on.
We were joking. We don't know legislation, why they name what they name it, we're not getting into it. One big beautiful bill. Some people may think it's beautiful, some people may not. What matters is your own game plan,
and your game plan should not change necessarily because of this.
Yes,
you may have a few more dollars in your pocket. There are some tools that you can use differently, like the 529, and but at the same time need to be aware, but also what we talk about on this podcast and what we think makes people successful is not changing. Right, Baileigh?
Correct.
Budget.
Oh, my favorite word. Let's go.
Save early. Save consistently.
Live in your means.
Live within your means. Long-term savings.
Yes.
Vehicles. If you're young, stock market is typically where you want to be. Like, none of that changes because of this. These are really information, more stuff government.
Yes.
More governmental stuff than really that are going to affect everyone's everyday life. What
we like to coach and talk about is you can't control Congress, right? And if you want to, go advocate, go do all those things, more power to you if that's something you're very passionate about. But what you can control is whether you spend $300 on crap for a month. And what I mean by crap, eating out and not invest in any. Like, it's people are like, oh, I don't have any money to invest this month. But there's Stella's budget. I always say Stella's because that's where mine's. But
DoorDash.
Yeah. But what you can control, right? The noise right now is new tax bill headlines, right? Everyone's like 900 pages, big, beautiful bill. It's smeared everywhere. It's very controversial both sides because it's politics and there's always controversies in politics. But what you can actually control, your contribution rate, your saving habits. And then the election panic, that's another noise. What you can control, working with a great advisor or investing your allocation risk tolerance accordingly. Let's not be 20 years old, scared, investing at 1-2% return when you can be aggressive, taking advantage of these turbulent times. I think about this a lot. Social media, TikTok, Instagram, the fear mongering. I mean, I even have younger clients that are like, oh, I watched this on TikTok and the stock market's going to crash and all these things. I'm like, if it crashes, we got problems. Like, you guys understand that, right? We're not worried about retirement, but do you have your beneficiary set up? Do you have your will done? Those are things you can control that are very important. And like, are your things taken care of? And we really preach that on this podcast.
Yeah. The stuff that we talk about, increasing your contribution rates every year into your 401k, none of that changes. All this stuff that's Bailey's talked about, none of it changes as far as being a consistent saver and being able to retire when you want to. That's Kole talked about that when we were talking about like what our goals are. His goal is to be able to retire when he wants to and be able to do what he wants.
Work optional.
Work optional. That's right. That was the word for it. I like it. And that's what you should be saving for and doing the tactics that we've tried to teach you through the podcast. If you want to be work optional, none of this changes any of that.
Yes. I mean, we're not saying these tax strategies don't matter. They do matter, especially for people with plans and that are working with people, but we're saying behavior over policy, right? Your behavior of your financial plan is going to win every single time over a policy. Ignoring the budget and letting emotion drive you during these 5 years, we've had clients and just saying, oh, it's too much. I can't look at it. There's too many changes. That's a behavior thing, right? You got to just go with your plan. So yeah, I think there's 3 things you can control outside of Congress right now: your contributions, your spending, and your allocations. You know what I mean? Those are things you actually are in control of. Contributions. Are you doing your Roth? Are you doing your 401k? See, I always say Roth first because it's like,
well, if you can do a Roth.
Yeah. Did you get a raise? If you got a raise, did you adjust it? Or are you just living, you know what I mean?
You're just living more freely.
Yep. Spending habits, track. We talked about this in our budget one. This was really good. Tracking your expenses, like just seeing where the money is going. Like, do I really not have $300 a month to invest, or is it just not a priority? Like those behavior change languages. And of course, your asset allocation. What I mean by that is your risk tolerance. Like, what are you actually invested in? And I think that discourages a lot of people from investing because they're like, I don't understand it. I don't understand mutual funds, stocks, bonds, ETFs, whatever. That's not the point. Just go work with someone and educate yourself. It's very simple. It's not a complex thing, right? It's just understanding you're putting money into businesses. These businesses grow. Do you want the growth of that? So
if you don't know what your asset allocation is, that's where you know that you probably should be working with somebody that will help you with this. And that is an important thing because we do get those clients that come in that are 25 years old and they got all their money in guaranteed interest, and we're like, why do you have it like that? And they're like, I didn't know how to set it up, so that's how I set it up because I didn't.
Or I talked to my coworker
because the stock market was going down at the time, and so don't set it up how your neighbor sets it up. Don't set it up how your coworker sets it up. If you work with, if you don't understand it, if you do understand it and you want to set it up yourself, by all means. But if you don't, that's where you need to reach out to one of us, a financial advisor in your area, have someone you trust.
So let's end it with this. Behavior over policy. Yes, be informed. I love being educated. We do not ignore these bills. We do not take them lightly. There's a lot of changes. They do impact our planning, how we help you. But again, we truly believe your plan will be successful with consistency, contributions, reviewing, and just working through the little things. There's a lot of noise, so don't panic. And some people are really excited about this bill. And that's every single bill. I've never met a bill where everyone was on the same page. No
Never.
pun intended. 900 pages. But yeah. So
you said it great.
Yeah. Also, a couple things. So let's wrap this up. That was the big, beautiful bill. What to know. We do have an event coming up October 9th.
Yes.
It's now called the Crossroads Event Center.
Used to be the Starlight.
Yep. Social Security.
In Fort Dodge.
I like how we're doing this.
Yeah.
6 o'clock start time. Don't be late.
Our guest speaker is Ernie Flebig.
Love him with Allianz.
And I don't have anything else.
Mexican. Come on. Food and libations.
And beverages will be complimentary.
Yep. Open to the public. And this is really for people, again, changing things, Social Security. It's educating yourself. If you're about to be in Social Security, you haven't drawn Social Security, it's open to the public. This is really an educational event to say, hey, this is what Social Security is, We have an expert here. It's fun.
It's meant more for probably people that are getting closer to retirement. But we've had 40-year-olds people come and they really enjoy it because they're like, oh, I didn't know that. I didn't know that affected my soul. Like, it's not necessarily that you can't come to it if you're 35, because if you just want to learn more about Social Security and how it works, by all means,
hang out with us.
Yeah. Well, that's the most important thing, of course. But it is a great night that we do this, and
we love doing
these events. We do. We like doing seminars, and it's completely open to the public, completely free. You don't have to commit to anything. There's no like, hey, you got to set up a meeting with us if you come. So if you feel like getting some more information about Social Security,
we have a great speaker,
and the speaker is awesome. Yeah, Ernie does a great job.
So all right. Well, if you know someone that needs to learn more about the big beautiful bill, share
or finances
finance in general, because this is not, we got a lot more better episodes, but great episodes, this one included. But like, subscribe, share. It's always nice if you like this content, financial content. We want to get it up there. That's why we do this. The algorithm loves when you follow a podcast. I know that because I follow a bunch, so we appreciate that. And
leave us a review. That'd be great too.
5 stars.
Hopefully. So as some of you may know, Ryne Sandberg, one of my childhood heroes, passed away yesterday at the age of 65, unfortunately, to cancer. So he was a Cubs legend, Hall of Famer. Never won a World Series, but he got to see the Cubs win a World Series in 2016. But Rhino, you will be missed.
And Rhino said, if you played the game the right way, played the game for the team, good things would happen.
Amen. Go Cubs.
You've been listening to How to Money with Kole and Kole, the podcast of Full Swing Financial Planning. To learn more, visit their website at www.fullswingfinancial.com and follow them on Facebook and LinkedIn.
For now, I'm Kole.
I'm Baileigh.
And I'm Kole.
And we'll see you on the greens. 4!
Security and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.